Ladies and gentlemen, let me be very clear from the start. What we are seeing right now in silver is not normal market behavior. It's not noise. It's not speculation. And it's definitely not something you ignore and come back to later. If you own silver, real physical silver, you may be standing at the edge of one of the most important moments this market has seen in a very long time. And moments like this don't announce themselves loudly. They whisper first and they move fast. Silver is on the brink of a historic shift. And that statement isn't based on excitement, headlines, or short-term price movement. It's based on structure, it's based on math, and it's based on patterns that repeat. Every time a monetary system stretches itself too far and begins to lose credibility. For years, silver has been treated as an afterthought, overshadowed by gold, dismissed by mainstream finance, and misunderstood by most investors. Yet, quietly, consistently, the fundamentals have been tightening. Supply has failed to keep pace with demand. Inventories that once acted as buffers have been drawn down. Industrial usage has grown, not contracted even during periods of economic slowdown. And unlike many commodities, silver doesn't have a meaningful substitute when it's needed. It's needed in physical form. Markets can ignore these realities for a long time. They can distort price through paper mechanisms, leverage, and sentiment, but they cannot repeal physical law. When more silver is required than can be economically produced or delivered, the imbalance doesn't resolve through discussion. It resolves through repricing. What makes this moment different is not just the silver market itself, but the environment surrounding it. We are operating inside a global financial system built on expanding debt, declining purchasing power, and increasing dependence on confidence rather than substance. Currency Units alerts, if I create a copy, top traders automatically follow proven traders in real time with smart position sizing track, verified performance set risk controls, and diversify across multiple strategies for. 8 rated by 19 start copy trading sponsored are being created at a pace that has no historical precedent. While real growth struggles to keep up, that gap has consequences. Eventually, trust becomes the limiting factor. Silver has always been sensitive to trust more than gold. It reflects stress, distortion, and transition. It is smaller, more volatile, and far more responsive when sentiment changes. That's why silver doesn't move gradually when the shift comes. It moves suddenly. It moves, and most people are still debating whether anything has changed. Another critical factor is that silver today serves two masters. It is both a monetary metal and an industrial metal. That dual role creates tension. On one side, investors seek protection against currency erosion and systemic risk. On the other, industries require silver for energy systems, electronics, medical applications, and emerging technologies. When both sides demand the same physical supply at the same time, price becomes secondary to availability. For a long time, above-ground inventories masked this tension. Stored metal acted as a shock absorber, but those inventories are not infinite. Once they decline beyond a certain threshold, the market stops functioning the way it used to. Delivery matters, timing matters, and confidence in paper representations begins to erode. This is where historic shifts begin, not with panic, but with quiet recognition among those paying attention. Large players don't announce their moves. They position first. They understand that when a market is small, like silver, even modest reallocations of capital can have outsized effects. It doesn't take the whole world waking up. It only takes enough demand to overwhelm a fragile structure. People often ask why silver hasn't already reflected these fundamentals in price. The answer is simple. Price discovery has been delayed, not eliminated. Distortions can persist longer than expected, but they also unwind faster than expected. When the unwind begins, it rarely offers second chances. This is not about predicting an exact date or price level. Precision timing is a distraction. What matters is understanding phase change. Markets don't move in straight lines, they move in regimes. Long periods of suppression are followed by short periods of violent adjustment. Silver has spent years in the former that the conditions for the latter are assembling. Those who already hold physical silver are not speculators in this context. They are positioned participants in a system that may soon repry risk value and trust, but ownership alone is not the end of the process. Preparation is about clarity, knowing why you hold it, how accessible it is, and what role it plays in your broader strategy. The biggest mistake people make during transitions is waiting for confirmation from the crowd. By the time consensus forms, the opportunity to prepare calmly is usually gone. Premiums rise, availability tightens, decisions become rushed instead of deliberate. Silver's historic role has never been to make people rich overnight. Its role has been to preserve optionality when systems change, to provide a bridge between what was trusted and what will be trusted next. And right now, that bridge is beginning to look very relevant. Again, this moment doesn't require fear, it requires awareness. Awareness that systems built on leverage eventually test their limits. Awareness that physical reality asserts itself when confidence weakens. An awareness that silver, despite its long periods of neglect, has a habit of reminding markets of its importance at precisely the wrong time for the unprepared. When the shift becomes visible to everyone, it will already be underway. Those who understood the signals early won't need explanations. They'll recognize the pattern because they've seen it before, and they'll know that silver is no longer waiting. We may be approaching a critical monetary and systemic threshold, and this is not a dramatic statement meant to capture attention. It is an observation grounded in history, structure, and the way complex systems behave when they are pushed beyond sustainable limits. Financial systems do not fail all at once. They stretch, distort, and adapt until they can't. And when that point arrives, the shift is rarely orderly. For decades, the global monetary system has relied on one central assumption that confidence can be maintained indefinitely through expansion. More debt, more liquidity, more intervention. Each cycle required a larger response than the one before it, not because it was more effective, but because the underlying problems were never resolved. They were deferred, and deferred problems do not disappear, they compound. We are now operating in an environment where debt is no longer a tool but a dependency. Governments require it to function. Corporations rely on it to survive. Got Honda to maintain living standards that no longer align with real productivity. When a system reaches this stage, it becomes highly sensitive to trust. Any disruption, economic, geopolitical, or psychological, has an outsized effect. This is where thresholds matter. A threshold is not a single event. It is a point at which the system's behavior changes. The rules that worked before stop working. The levers that once restored confidence begin to lose their effectiveness. We are seeing early signs of this now. Interest rate adjustments no longer produce clean outcomes. Currency stability requires constant reassurance. Markets react, and not to fundamentals, but to expectations of intervention. At the heart of this issue is the nature of money. Modern currencies are no longer anchored to tangible constraints. They are promises backed by future confidence. That model can function for long periods, but only as long as the belief in future stability outweighs present evidence of imbalance. When that balance shifts, the system begins to search for anchors, things that do not rely on promises. Historically, when monetary systems approach this kind of threshold, capital behavior changes. It becomes less speculative and more selective. Liquidity does not disappear, it migrates. It seeks clarity, durability, and optionality. Assets that once seemed irrelevant or inefficient begin to matter again, not because they generate yield, but because they do not carry counterparty risk. What makes this moment particularly fragile is the scale involved. Never before has the global system been so interconnected, so leveraged, and so dependent on synchronized confidence. This creates efficiency during stable periods, but it also amplifies stress. A problem in one area no longer remains isolated. It transmits through currencies, bond markets, equities, and trade flows almost instantly. There is also a psychological component that often goes unrecognized. Long periods of stability condition participants to believe that intervention will always succeed. That belief becomes self-reinforcing until it isn't. When people begin to question whether the tools still work, behavior changes rapidly. Spending slows, hedging increases, liquidity, preferences shift. These changes don't require a collapse, they require doubt. A systemic threshold is crossed when the cost of maintaining the illusion of stability exceeds the benefit of preserving it. At that point, authorities are forced into difficult trade-offs, protect currency value, or support markets, control inflation, or stimulate growth, maintain credibility, or prevent short-term pain. These are not decisions that can be optimized. They involve losses no matter the path chose. In such environments, volatility is not a malfunction. It is a signal. It reflects the market's attempt to reprice reality in the absence of clear anchors. Traditional models struggle because they are built on assumptions that no longer hold risk correlations increase. Diversification benefits shrink. What once looked balanced begins to move together. This is why preparation matters more than prediction. Thresholds are recognized in hindsight, but navigated in real time by those who understand the structure. Waiting for official confirmation is usually a mistake. By the time a systemic shift is acknowledged, options have narrowed. The purpose of recognizing a threshold is not to induce fear, but to restore perspective. Systems change. They always have. Monetary regimes evolve not through consensus, but through necessity. Those who understand this focus less on short-term noise and more on resilience. They think in terms of access, liquidity, and independence rather than return alone. We may not know the exact form the next phase will take. It could unfold gradually, or it could compress into a much shorter time frame than most expect. But the indicators suggest that we are closer to a transition than to stability. When confidence becomes the primary variable, adaptability becomes the primary strategy. History does not repeat perfectly, but it does rhyme. Every major monetary transition was preceded by denial, followed by surprise, and then rationalization. Those who navigated them successfully were not the ones with the best forecasts, but the ones who respected the limits of the system and positioned accordingly. Approaching a critical threshold is not about timing an end. It is about recognizing that the assumptions of the past may no longer apply to the future. And when that realization spreads even quietly, the system begins to change whether it is ready or not. Physical silver's scarcity and institutional blind spots are converging in a way that few are prepared to recognize, let alone respond to. This is not a sudden development. It is the result of years of quiet mispricing, structural assumptions, and a persistent disconnect between paper representations of silver and the realities of physical supply. What makes this moment important is not that silver is scarce in an absolute sense, but that it is scarce where and when it actually matters. Large institutions tend to operate within models. Those models are built on historical availability, liquidity assumptions, and the belief that markets will always clear if price is adjusted. That framework works well in deep, highly liquid markets. Silver is not one of them. It is a relatively small market with limited above-ground inventories and a growing list of essential industrial uses that cannot be deferred indefinitely. When institutions apply big market logic to a small market asset, blind spots emerge. One of the most persistent blind spots is the assumption that silver is always available in size on screens. That appears true. Contracts trade, volume looks healthy, price discovery seems continuous. But screens do not deliver metal. They represent claims, offsets, and settlement mechanisms that function smoothly only as long as confidence remains intact. The moment delivery becomes the focus rather than price. The nature of the market changes. Physical silver moves through a narrow pipeline. Mining supply grows slowly and often as a byproduct of other metals. Recycling helps, but it is price sensitive and time delayed. Inventories once thought to be ample have been drawn down to support years of deficits. This means there is far less slack in the system than most models account for. When demand increases unexpectedly or persistently, there is no quick way to respond. Institutions also tend to underestimate the stickiness of physical demand. Industrial users cannot simply stop consuming silver without disrupting production. Investors who acquire physical metal often do so with a long-term mindset. They are not traders, they are holders. Once metal leaves the available float and moves into private hands, it rarely returns quickly. This reduces effective supply far more than headline numbers suggest. Another blind spot lies in the reliance on substitution. On paper, alternatives exist. In practice, many applications require silver's unique properties. Attempts to reduce usage often hit technical or economic limits. As demand from technology, energy, infrastructure, and medical applications grows, the margin for substitution shrinks. This creates a situation where price can rise significantly without meaningfully reducing demand. There is also a behavioral element. Institutions are conditioned to respond to volatility, not scarcity. They manage risk through hedging, derivatives, and diversification. Physical shortage is not easily hedged. It introduces a different kind of risk, one tied to logistics, timing, and access. These are not variables that fit neatly into traditional risk models, so they are often ignored until they become unavoidable. This is where disconnects form. Price may remain subdued even as physical tightness increases. Signals are delayed when recognition finally occurs. It tends to happen all at once. Institutions then compete for a supply that is no longer there in the quantities assumed. In small markets, that competition does not resolve gently. Another overlooked factor is the role of trust. Much of the silver market operates on the assumption that paper claims can be converted to physical when needed. That assumption holds until too many participants attempt to do so simultaneously. The system is not designed for universal delivery. It is designed for netting, rolling, and cash settlement. Most of the time, that distinction doesn't matter. During periods of stress, it matters a great deal. Private holders of physical silver are often dismissed as irrelevant to institutional flows. That is a mistake. In aggregate, they represent a significant and increasingly immobile portion of available supply. Their behavior is not driven by quarterly performance metrics or risk committees. It is driven by a long-term conviction that makes supply less responsive precisely when responsiveness is needed. What we are seeing now is the early stage of recognition. Not panic, not euphoria, just a gradual realization among informed participants that assumptions may be wrong. That realization spreads quietly. It doesn't require a headline, it requires experienced missed deliveries, rising premiums, longer lead times. These are the real signals of scarcity. When institutional blind spots meet physical constraints, the adjustment process is rarely smooth. It tends to be nonlinear. Small changes in demand can produce large changes in price and availability. This is not because silver is special, but because it has been treated as unimportant for too long. The risk for institutions is not that silver becomes volatile. It is that access becomes unreliable. That is a different problem entirely. Volatility can be managed. Scarcity cannot be engineered away on short notice. It forces behavior change rather than portfolio adjustment. For those paying attention, this is not a reason for alarm, but for clarity. Their markets function on assumptions until they don't. Physical reality has a way of asserting itself when confidence and abstractions weakens. Silver has always been a metal that exposes those moments. As this dynamic continues to unfold, the gap between perception and reality is likely to narrow. When it does, it won't be because models were updated or narrative shifted. It will be because physical constraints made denial impossible. And by the time that becomes obvious to everyone, the opportunity to respond calmly will already have passed. So let me leave you with this thought. Silver has never been just a metal. It's a mirror reflecting roofs, stress, and truth in the financial system. Right now, that mirror is starting to crack the illusion that everything is fine. If you own silver, don't panic, but don't be passive either.